In today's video, we're diving into one of the most effective smart money setups called the Power of Three, also referred to as AMD. Make sure to stick to the end of the video because we will cover a lot. Starting from what this pattern really is, how to spot it on your charts, and the key rules for trading it effectively. We will also walk through some real chart examples. So, if that sounds interesting to you, make sure to hit the like button, also subscribe, and turn on the notification bell to stay updated with our latest videos. Now, let's get started. First, what is the Power of Three? The Power of Three is simply a price action pattern that unfolds in three main stages: the accumulation, manipulation, and distribution. The accumulation phase is a period where the market moves sideways without a clear direction. During this time, price tends to form equal highs and lows, which attracts stop-loss orders and builds liquidity around those levels. This pattern can look different depending on the time frame. On higher time frames, for instance, it might just appear as a group of choppy candles. Next comes the manipulation phase, which occurs after accumulation. This is when the market appears to break out of the range, but quickly reverses, making a move commonly known as a fake out. In basic price action terms, when the price drops below support, that level typically becomes resistance, causing price to decline further. This happens because some traders use the retest as a chance to exit long positions, while others see it as an opportunity to enter short trades. The combined activity causes the price to bounce back. However, if price doesn't continue in the breakout direction and instead snaps back into the previous range, it will be considered a fake out. Fake outs can actually be powerful indicators of upcoming price moves. When a breakout turns out to be false, it usually means the move was deliberately designed to trigger stop losses and draw in breakout sellers, effectively collecting liquidity beneath the range. Once smart money has absorbed enough of this liquidity, the market often makes a strong move in the opposite direction. This is what we call the distribution phase. As smart money traders, our goal is to capitalize on this movement. We wait for the stop losses to be swept and enter the market after the manipulation has occurred. So the structure we look for includes accumulation, manipulation, and finally distribution. So now that you've seen what this pattern is all about, let's go to the chart and see how we can use it to trade. To trade this pattern, you first need to spot price consolidation. Like what we have here on the chart, you can see that price is just moving sideways, creating a series of equal highs and equal lows. This is what we call the accumulation phase. Next, price breaks out of the range but reverses sharply, closing back inside the range. This move is known as the manipulation, which is designed to trigger stop losses and grab liquidity beneath the range. Now, when this breakout happens, we don't just jump into trade. Instead, we wait for confirmation that the manipulation phase has ended. That means price must re-enter the range with a candle close. This confirms the breakout was fake. When this happens, we then enter at the candle's close, place our stop loss just below the swing low, and aim for key target levels ahead in the direction of the new trend. And letting the trade run, you can see how price pushed from there and made a significant move to the upside, giving us a winning trade. This real move right here is what we call the distribution, which usually happens when liquidity has been collected above or beneath the range. Let's look at a bearish example. Here on Bitcoin chart, we can see this price consolidation which indicates the accumulation phase. Next, price broke out to the upside, but sharply reverses into the range, making the move a fake out. Now, according to what we discussed earlier, the fake out move is the manipulation, which is a move designed to trigger stop losses and generate liquidity for the real move to occur. Now, seeing that price has closed back into the range after the fake out is a confirmation that the manipulation phase has ended. So we just place our entry at the candle's close, set our stop loss just above the swing high, and our target at 2 times the stop loss. And letting the trade run, you can see how price pushed down and gave us a winning trade. So this is simply how you can use this pattern to trade profitably in the market. Remember, trading live involves real money and real emotions. It's a whole different game compared to paper trading or simulations. The The key to success is sticking to your trading plan, which acts as your blueprint for success. If you found value in this video, make sure to hit the like button, also subscribe, and turn on the notifications to stay updated with our latest videos.